A new financial crisis has developed recently in America, says stock market expert Matt McCall. And the trail of destruction it could leave behind will look nothing like what you might expect. In fact, McCall warns nearly 40% of the elite, publicly traded companies, brands you've known and used your whole life, could go bankrupt because of a strange market event he calls the flippany, wiping out thousands of investors' fortunes. McCall has written a brand new report explaining exactly what the flippany is, how billionaires are already profiting from this big event, and what you should be doing to prepare as well. To get a copy of his new free report with all the details, simply go to stockmarketflip.com. Again, that's stockmarketflip.com for a free copy of our report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show, where we are closing out our summer series with the Contrarian's Contrarian. Please welcome back to the show to close out the series, Harry Dent. Harry is the founder of HS Dent and the editor of the HS Dent Forecast. He's also the founder of Dent Research and the executive editor for Economy and Markets newsletter. Harry, always good to see you.
Yeah, nice to be back.
Well, I'm happy to have you back because the last time I thought, is Harry going to come back to the show? I kind of held your feet to the fire with when it came to your timeline of you calling a stock market crash. But I have to give you kudos now because the last time we spoke, you said the biggest stock market crash of our life would happen in 2022. So just to frame things up for folks, it was the worst first half of the year in 50 years. And this year is already one of the worst in terms of big daily declines, with the S&P 500 falling 2% or more on 14 occasions, putting 2022 in the top 10 list, according to data compiled by Bloomberg. So, congrats.
And there's more to come. These things are not over in 1 year. This will take 2 to 3 years to work out. So there's plenty more to come.
Okay, so I want to dissect this all, unpack this all, because as we're speaking, the S&P is heading into its third consecutive week of wins here. Many experts saying the likelihood of retesting June lows now seems quite slim, given the really robust jobs reports, which have eased recession fears. The market is also saying that it can withstand more rate hikes from the Fed. Harry, where do you see things now?
Okay, a crash like this, you'll see 3 waves of crash. What we've seen is the first wave down. And of course, that's the most important one, because if it's 10 or 20%, then it may not be the beginning of a larger crash. We can always go to new highs. This one was 35% on the Nasdaq, 25% on the S&P. So that 30% plus range qualifies it as yes. This looks like the first crash, which means now we're in the bounce from that crash where everybody's gonna say, oh, it's over, and one good jobs report, okay? You know, how much is job stuff? We're still catching up from COVID and stuff. So we are in a recession. All the signs point towards a recession. Everybody says it's gonna be shallow. That's what the experts say every time we have a recession. Here's the truth about this thing. This recession, it started in 2008-9, which is really more a depressionary period from such a bubble of such a magnitude. That should have been deeper and longer. That crash should have gone into mid-2010 and been a lot deeper. Stocks should have been down 80%, not 50-some percent. So they blew us out of that. Now, despite stimulus, they overreacted to COVID, which was a huge mistake because now they have to tighten, because they overreacted to COVID, and COVID is a temporary crisis by definition, not a long-term crisis. But the economy is getting weak again. Now I'm just let people figure something out for yourself real quick. Let me tell you what happened during COVID. $5.1 trillion in fiscal stimulus and $5 trillion in monetary stimulus in 2 years, almost half of GDP, and we're already falling into a recession again despite that, okay? It shows what I'm saying. The economy is weak because the baby boom peaked back in 2007. We're in the weakest part of that downturn demographically, the biggest demographic downturn in history, until about 2024, still a year and a half from now before we start to recover. So this downturn is going to have to be deep to wash out all the debt and all the bubble stuff. We can't just come roaring out of this and say we're over it. This is the first wave down. We may be close to the end of this bounce. So consider, here's how it goes. A first wave crash down, two-wave counter trend, okay? Retraced 40 to 50%. We retraced about 40% now, so this could be over soon. Then you get the next wave down. That's called the three wave. That should be the same size and length of this wave or more. So we're probably going to see another wave down from sometime this month into January of next year. And if the market's down into January 2023, just the January indicator would tell you the whole year is going to be down. So that'd be the next wave. Then you'll get a bounce, and then the final wave will come into late 2023 or early 2024. That's what you should expect after a bubble of this magnitude, especially one that's been stretched and stretched and stretched. The economy's never been able to wash out all this excess. 600 trillion of financial assets that are more overvalued than any time in history. Frankly, and I show this in my newsletter, we've been telling our subscribers is we have $600 trillion now in financial assets, 6.5 times GDP globally, and that normally would be 2 times GDP in normal times. So this bubble has to unwind. That means hundreds of trillions of dollars of financial assets. What is that? Real estate, stocks, bonds, commodities, gold included in there, all have to deflate back down to normal so we can come out of this. And we have to flush out bad debts, the highest debt ratios. Can't even compare the debt ratios globally and domestically to the roaring 20s and past bubbles like this. So people need to understand, this is the greatest financial asset bubble in history. There is no soft landing to this, period. There is no magic way to get out of it. Now that this thing is cracked this far, I've been telling our subscribers for months and years now, it'll come to a point where they keep stimulating, but it's not enough and the economy breaks down anyway. We are in the beginning phases of that, and it's very, very likely this is going to continue. So don't listen to all of the clueless economists that never thought this could happen in the first place and saying, well, this will be a mild recession and the worst is over. I am telling you, it is not. And you are risking your assets if you do not take this seriously. All you got to do is be more conservative, be in the highest quality bonds while this crisis is happening. And all you need to be is out for about 2 years to let this happen, okay? If I'm wrong, you'll miss some minor gains after things have gone up so much that they're so overvalued. If I'm right, you're going to save your assets while most people are going to lose them and never get back to even again. This is once in a lifetime. This is not another recession. It's not another 20% stock crash. This is going to be the biggest crash you have seen in your lifetime, more comparable to the 30s, not quite that bad, and that you will see for the rest of your lifetime. That's what I am saying.
You speak with such conviction, Harry, so I want to know why you're so...
I do my homework, that's why.
I know you do your homework. Okay, so few questions here, and let me play devil's advocate. Okay, but first, you see a total of a 90% correction in equities, correct?
I see my target. Now, this is his best estimate. Yeah, 86% from top to bottom. We already peaked in January 4th on the S&P and November 22nd on the Nasdaq. I see 86% to get to the bottom of the S&P a few years from now and 92% for the Nasdaq. So yes, in that 80 to 90% range. Again, you have to go back all the way to 1929 to 32 when we saw an 89% crash.
Let me ask you, okay, but let me play devil's advocate now. We have midterm elections, then we have the election. If your timeline is correct, don't you think they will do everything in their power, right? Because how do you win an election? You can't have a weak stock market. You can't have high inflation. You definitely can't have a recession. So wouldn't they do everything in their power to avoid this scenario? Could you not see them raising?
They already did it. What I said from the beginning is key. I've been waiting for them to get caught in their own trap. What they did was they've been stimulating ever since early 2009. And every time it slows, they just up it exponentially. They printed more money just in the last 2 years of COVID than they did in all the cumulative 13 years before that. So they've been escalating stimulus. The problem is they overreacted so much to COVID, which to me, you don't need to overreact to. Everybody can understand that you get a huge virus that makes a lot of people sick and closes down some businesses, that the economy is going to slow. It doesn't mean there's something wrong with the economy and somebody made a mistake. It's just a natural event. No, they know they have to keep the economy going no matter what. So they overreacted. $10 trillion of stimulus in 2 years, 50% of GDP, to the point now that they have to tighten. They force themselves in a tightening cycle. And the difference between me and the government here is I'm saying the economy is so weak that this tightening is going to fail faster than they think. This tightening is not going to last long because the economy is not going to react well to it because it is so much weaker. Right. They think they're mistaking all this stimulus for the economy's growing again. This has only been stimulus. It's the only reason we've been growing since 2009.
But if the tightening, if they're going to reverse course on the tightening and QE starts up again and the money printing starts up again, doesn't that keep everything, doesn't that just keep the good times rolling then?
No, let me tell you why. If
break it down for me.
Finally tightening and they suddenly say, oops, we shouldn't have tightened, what is it saying? The economy is really weak. So it causes people to doubt the economy even more. So first of all, yes, they will do this. I'm saying because they've gone in this direction, it's hard for them to change so suddenly, so soon without showing a bad signal. And governments don't do that anyway. By the time they react, it'll be too late. What I'm looking for, and here's where you'll see if I'm wrong, okay? I'll just tell you why I'm wrong. Why I could be wrong. If we see another wave in stocks go down similar to this one, and the next stop on the Nasdaq is 7,000 something instead of 10,000 something, people are going to know we're in a serious crash. We're going to move into a serious recession, and then it's going to be hard to stop the momentum. I think that we could be starting that crash soon, and that's what catches the government off guard. And by the time they react, it's too late. And you got to remember, if they've been stimulating nonstop for 13 years and we keep getting a weaker economy, and that has been what's happened, okay? Ever since the 2002, they keep stimulating more, and the economy keeps falling to new lows, the stock market. And so people are going to start to see this isn't working. You can't keep a dead economy going because it takes more and more stimulus with less and less effect.
The perception is that the economy is robust, though. So let's take it a step back. Say if they, play this out for me. Explain this to me. Say if they had not started tightening, right, and they just kept printing money, kept QE going, how would have that played out? Like, couldn't they have said, well, let's just keep this perception, this illusion up, right? Keep the good times rolling. Couldn't you keep that going on, or what would happen?
Okay, well, what changed in the last year? What changed? Just think, what's the one thing in the economy that suddenly changed? Inflation went from 1% to 9.1% and 0 to 60. That's what kicked their butts, okay? That's what stopped this thing. How do you think you can print more money and not create inflation? The only reason it didn't otherwise, the economy was weak and the demographics were slowing, and that kept a lid of inflation. What I'm saying is since they don't know what they're doing and they don't understand the damn economy, because people never run a business or had sex for that matter, all these economists, they don't understand what's going on. They made a mistake overreacting to COVID, and now that has called their hand, forced them to tighten, and if they turn around too quick on tightening, it's going to send a signal that the economy is even weaker than anybody thinks.
That said,
there's no way to win at this point.
That said, I'd love to get your thoughts on the Inflation Reduction Act that's now going to go onto President Biden's desk to sign. What is it?
This is a long-term policy. This is a short-term crisis. They got sudden inflation because they created the biggest bubble in financial assets in history. Financial assets, any young person today has no chance of investing in retirement, where every market from bonds to stocks to real estate is so overvalued that at best it can go sideways for decades to come, and at worst it goes down and you lose money. We need to deflate this financial asset bubble so that things go back. Housing, what's the biggest problem in our economy? Young people can't afford to buy a house. You know what a house was, an everyday house was 20 years ago? $120,000. You know what it is now? $420,000. What does that do to your standard of living if you just got married and had 2 kids? You can't afford to buy a house. And if you do, you can't afford to buy anything else. And interest rates are artificially low when they go back to normal levels because government's pushing out, then all these mortgages and stuff are going to cost more. They have basically, we've been living in an artificial economy. You don't get something for nothing. You can pump it up for a while. Hey, I tell people it's this simple. If I want to feel good today, I can feel good. I don't care how bad I feel. All I got to do is take heroin or cocaine or something or 10 cups of coffee and I'll be up. Does that work? Is that healthy? No. We've been doing this for years, living on artificial stimulus, stretching an economy past when people needed to spend money. The baby boomers were overspending their money and buying all their houses in 2007. I predicted that 20-some years in my newsletters and books before it happened. And then we went into the great crash in 2008, and these people panicked, and they don't realize they need to recalibrate the economy to make the best of a slow economy rather than hyping it up with artificial financial drugs.
Well, that's
where I call it the market's on crack.
To your point
Not
about
healthy.
housing. To your point about housing, someone argued that that's why a house right now is the greatest commodity you can have. Would you agree with that?
No, it's the worst commodity because they're going to go, mark my words on this and shoot me if I'm wrong. Next few years, housing in the United States is going to go down 50%. You know what? People said that couldn't happen. It already went down 34%, and I predicted that, okay? Already went down 34%, more than in the Great Depression, not because the economy was worse than the Great Depression, nowhere near that. It's because we didn't have a bubble back then. You couldn't buy a house with no money down, with damn near zero rates and speculate like you could. In the roaring 20s, in that bubble boom, a house you had to put 50% down, and the longest mortgage you could get is 5 years with a balloon payment. That's what's different now. So housing had a big crash, but of course they pushed us out of it. The next crash, mark my words, 50%. Most people who got a mortgage in the last decade are going to be underwater. Banks are going to be underwater on loans. And then this thing's going to be a big mess. And they're finally going to have to write down loans. So what I tell people, here's the classic thing I get when somebody hears my presentation. Oh, Harry, I got 2 houses. One of them's all paid for. And the other one I just got a 90% mortgage. I'm going to sell the one with the mortgage. And I'm like, no, sell the one that you got all the equity and take all your money out because it's yours. Keep the one with the mortgage, because at some point, banks are going to have to write down these mortgages because they gave people mortgage they couldn't sustain. At some point, you got to write down the debt instead of just having more stimulus and keeping the crazy game going.
Last time we spoke, you also said that we had hit peak inflation. We've kept ticking higher on the inflation. Now a Fed survey shows future inflation expectations coming down sharply.
The economy's slowing because it's tightening.
So, okay, where are we going with inflation? Does it keep getting hotter, or are you sticking to that peak inflation theory?
This inflation should not last long because it was artificial. This is not real inflation. The inflation of the 70s, my indicators explain that and predict why it went down in the 80s and 90s. It wasn't government policy. It wasn't government deficits that caused it. It was the baby boom entering the workforce in great numbers at great expense and low productivity that caused the high inflation. It was real inflation caused for real reason. This is totally artificial from the over stimulus for 13 years now, and especially the overreaction, 10 trillion in stimulus in 2 years. That's why this is short-term inflation. A recession will bring this down. We come out of this recession in 2024-25. Inflation is not going to come back substantially with it. It may go back to 1 or 2% at most. Inflation is a thing of the past as long as governments stop printing money exponentially, which I think they're going to lose credibility and have to stop doing that. Hopefully.
Okay, let's get to that part of the segment that I like to call, where do you seek refuge in all this mess? I know you were very bearish gold and the cryptocurrencies. Yeah. You feel gold's going to 900. You said Bitcoin's going to 0. Okay.
Okay. Yeah, my forecast, and this is just best for you. It could be 10,000. My best My bet is it's going to go to simply the 2018 low after the last bubble crash, okay? That was 3250. So 3 to 4,000 is my target for Bitcoin. At best, it goes to 10. So we're not bottoming here at 20. Everybody think, well, now you buy. No, you buy it at 20. If it goes to 10, you lose another 50%. If it goes to 3250, you lose 70, 80%, okay? So you got to remember, the more it goes down, the less of a downturn it creates to have a big percentage loss. So it's still dangerous. It hasn't bottomed yet. It takes a couple years for a bubble like this to burst. And crypto is the future. I'm extremely bullish on crypto and digital currencies and money creation. It's a whole new money system emerging. It's in its infancy. It's having its baby bubble where it's get overvalued. It's got to crash. It's got to go from 40,000 coins down to some reasonable number, like whatever. It has to shake out. The dot-com industry did this. Amazon was a small company when it bubbled up in the late 90s and then crashed. Tons of dot-coms went under, and the strong like Amazon came out and went from $6 to 3,500 in the next boom. So I am crypto is the next big thing, but it has seen its baby bubble, and it does have to crash. And I put a number on that. Why did I get to 3250? I'm marking the same amount of crash for Bitcoin as Amazon, the leading dot-com, did, 95%. It might be 90, okay? Maybe it's 6,000. But if I had to bet, I'd place my bet. I'd be buying Bitcoin if in the next year or two it hits 3,000 to 4,000. I'd be pumping it up because I see Bitcoin going to 500,000 to 1 million in the next boom. Just not now.
Okay. So
I'm not bearish. And gold, yes, I'm saying gold goes from 2,000-ish down to 900 to 1,000, okay? That will be a lot better than stocks and crypto and other commodities. So gold I'm bearish on, but I'm less bearish on gold than most other financial assets. So if you have to have a little gold for diversification, it won't be the worst place to be. I say I don't want anything that's going to go down. I am projecting gold will bottom somewhere between 900 and 1,000.
So, sorry, just to get your timelines for gold and Bitcoin's bottom.
They will, okay, if anything, I think stocks don't bottom until at least the end of 2023 and maybe into early to mid 2024. If anything, Bitcoin, and particularly, Bitcoin and maybe gold will tend to bottom earlier than that. They are the bubbles, especially Bitcoin is the lead bubble. It will tend to crash faster and hit that bottom and tend to lead coming out of it. So I would say Bitcoin will see maybe 80% of its losses by the end of this year, or say early next year, January, February, and will, if anything, bottom several months before stocks.
Would you be buying treasuries here?
Absolutely. It is not gold. Gold was a safe haven. We were in an inflationary economy in the 70s. Gold is a hedge against inflation. That's what it's correlated the most with over its entire history. We're talking a deflation of an entire financial asset bubble like the 30s, and gold was fixed back then. So I can't say, see what happened to gold back then? Gold was fixed. So gold didn't go up, but it didn't go down much because they fixed the price. Gold should do what it did in 2008, just deeper. Gold went down 50% at the end there, or I think 45%, most of that in a couple months. It was the last to fall, but it went right with everything else. I think gold's going to be down more like 60% or more this time, but it's still less than other financial assets.
Okay. And you'd be buying treasuries?
Treasuries are the safe haven.
Okay.
And again, the longer term the treasury, the 30-year treasury is going to go up a lot more than the 10. TLT is the easiest to buy ETF, and that is a mix of those two, 20-year average. ZROZ, Z-R-O-Z, is leaning more towards the 30, so it's a 25-year average. The best thing to buy is 30-year treasury bonds, but the easiest thing to buy is ZROZ, and that will go up more, about 50% more than TLT. So the long-term treasuries are the only safe haven. AAA corporates are next, but why buy a AAA corporate when a treasury bond is even safer? If the US government can print money to keep a bubble going, they can print money to pay off their bonds, and they will. They will not default on that treasury bond. I don't care what happens.
Let's talk U.S.
Yeah,
dollar.
Weimar Germany. We're not in that.
I want to get your U.S. dollar thoughts. Is it just, what's the expression? The most beautiful
Yeah, best
wall at the
house in a
ball?
bad neighborhood.
Or, what? So thoughts on the U.S. dollar? What's your take here? Where do we go?
Okay, number one, this is a global debt bubble. Japan has printed more money and has higher debt ratios than we do. Europe has printed more money than we have and have similar debt ratios and higher of anything. We are, in the greatest debt bubble in history, still the largest economy, still have better demographics than our European and Japan competitors, even though they're starting to wane too. Our demographics are much more buoyant than Europe and way more buoyant. Japan just is they're not going to be a country at the end of this century. They're not going to exist. That's how fast people are dying off there, and they're having no babies and no immigration, okay? So we're the best house in a bad neighborhood, and the money's got to go somewhere, so it goes into the safest investments, U.S. Treasury bonds, other government bonds, or AAA corporates, but the U.S. Treasury bond was the best beneficiary in 2008. Here's the best way I can tell you, Danielle, to picture this crisis. It's going to last longer and go deeper. Take 2008-9 crisis, multiply it times 1.5. This is going to be 50% worse, 50% deeper, 50% longer. So stocks went down 57%, and I'm saying 86%. That's about 50% worse. That's the best way to keep. This is just 2008-9, but allowing to go all the way down, deflate this debt bubble, get rid of a lot of bad debts, which is extremely healthy for the economy long term. That's why you're going to come soaring out of this if you do that. That's the crisis. 50% worse than 2008-9. Instead of lasting 1.7 years, it's going to last maybe 2.5. Think of it that way.
Just to
Longer, deeper.
taking the conversation just in a different direction, we can wrap here. Do you think we're headed towards a digital dollar?
No, I think we're headed for a digital global currency system where Bitcoin is most likely to become the standard once it is universally accepted, much more value, $500,000, $1 million coin. There's a price, about $500,000 a coin, where Bitcoin becomes worth more than all the gold in the world and can continue to grow with the global economy, where gold is growing at 1% a year, global economy is growing at 5%. Gold cannot be the standard, so it'll be a digital system. Maybe the dollar is a big piece of it, or maybe there's one, but Bitcoin will be the backing eventually, not the U.S. dollar, probably. That's the way I see it.
You're talking about the future reserve currency of the world?
Yes, because here's the thing. U.S. has been the dominant country. We still have better demographics and grow a little more than Europe, but we go sideways. All the growth from here on out is going to be in the emerging world, number one, and more than that in Asia. It's all going to go west. So there's no way the U.S. dollar can continue to be the reserve currency for a global economy that's going to outstrip the U.S. and make it a smaller and smaller point. It's natural that the U.S. dollar in some way will not be the reserve currency. It may be part of a basket of currencies that becomes that with Bitcoin as a standard, or it might just revolve around digital currency. That gets more, but it is going to be more digital, and Bitcoin's more likely to be that standard 20 years from now than the U.S. dollar.
All right. I want you to bring it home for us. Like I said, you're closing out my summer series here that the folks just loved, filled with incredible content. Final food for thought for all our viewers watching. Bring it home, Harry.
Yeah, okay, listen, this is once in a lifetime. Most stockbrokers will tell you just stay with the market, they come back, and that's right 80% of the time. This is not that time. Do not listen to your financial advisor, even though they're right most of the time. It's the wrong time. And get on my newsletter. We have a free newsletter, okay? HarryDent.com. Very simple. You just get on. My partner and I will send you an article every week. And hey, if you want to decide to get on our main newsletter, that's fine too. But you need to be listening to us right now, because everybody's going to tell you, oh no, the government won't let this happen. Oh, it'll only be a mild recession. I'm telling you, this is going to be the crash of your lifetime, and it's going to affect your finances more than any event past in your entire lifetime or future in your entire lifetime. So you have to take this seriously. If I'm wrong, you're going to miss a couple of years of a market that's so overvalued, it's not likely to have much gains anyway.
There's your daily dose of sunshine, folks. Harry, I hope you you're enjoying your summer. I know it's ending soon, but how's it
I'm
going
in
so
Puerto
far?
Rico. I'm 2,000 miles out in the Atlantic Ocean. They could nuke the whole United States, and I wouldn't even hear it happening. So
All right. Well,
I'm
I
I'm
know who to
I'm part of
visit.
here because I love it. But this is a very safe place to be in a difficult time.
Well, I know who to call then. So,
Yeah.
Harry, it's always great fun having you on. I appreciate it. Thank you.
Okay. Thank you, Danielle.
And thanks so much for watching. We'll have more incredible content. I hope you enjoyed the summer series. I had a blast doing it, but we'll still have amazing content coming your way. And don't forget to sign up at danielacambone.com to stay on top of all these very, very important interviews in an extremely vital time. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.